The state of global markets is currently in flux, and most investors perceive this change as negative, hence the sharp drop in equity prices. The fundamental question is whether this drop has been excessive, insufficient, or appropriate. But making that judgment is nearly impossible with any precision. The recent imposition of tariffs has triggered fears of a paradigm shift away from the post-World War II era of global trade and toward economic isolationism. This could be the most significant environmental change in decades. For nearly 80 years, globalization has been a key driver of global economic growth. Countries specialized in what they produced best and traded goods across borders, resulting in widespread prosperity. Trade lowered costs, raised standards of living, and helped keep inflation in check, especially in the U.S., where durable goods declined in price by 40% over 25 years in real terms. Tariffs challenge this system by making imports more expensive, potentially driving inflation and reducing economic efficiency. While tariffs aim to boost domestic production, this comes at a cost. Domestic alternatives are often more expensive, and these costs are likely to be borne by consumers. From a financial perspective, the benefits of globalization were significant. If imported goods hadn't been available at falling prices, U.S. inflation would have been considerably higher. Tariffs reverse this trend by acting as a tax. Someone pays them, whether it's the exporter, importer, or consumer. In the end, society absorbs this cost. Given this changing environment, investors need to think critically. Stocks have historically returned around 10% annually over the past century. But that figure is heavily influenced by valuation levels. When the price-to-earnings (P/E) ratio is at its historical average of 16, returns tend to be around 10%. However, when the P/E ratio is elevated, say, at 19 like today, historical data suggests returns could drop to somewhere between 2% and 7% annually. The fixed income world, what we once simply called bonds, is more straightforward. You see a promised return on a piece of paper, and the key question is whether the issuer will deliver. Default risk is the central concern. In the high-yield market, experience has shown that about 99% of issuers keep their promises. But again, all investing is about judging whether the current prices are fair, too high, or too low. This is particularly hard today because the future is unusually uncertain. The past provided a reliable blueprint for the future, but that assumption no longer holds. The world has been shaken like a snow globe, and no one can confidently predict what it will look like in 6 months, much less 6 years. Because of this, forecasting becomes even more unreliable than usual. Successful forecasting requires 2 things: a view of what will happen and a probability that you're right. Today, even if you think you know what's coming, the confidence in that forecast has to be lower than ever. This leads us to a fundamental question in investing. Is this a time to be fearful or greedy? Legendary investor Warren Buffett often says to be greedy when others are fearful. Stocks are now on sale, down 8% in just a couple of days and more in the past 6 weeks. The market is full of bargains. Will prices fall further? Nobody knows. Are current prices justified? Again, nobody knows. But avoiding buying something just because it's cheaper than when you last looked makes no sense. Historically, the U.S. has been the best place to invest, thanks to its strong rule of law and predictable economic system. But that edge may be slipping. The U.S. has long lived beyond its means, operating as if it had an unlimited credit card with no consequences. But if international confidence wanes, if foreign investors become unwilling to hold U.S. debt due to rising deficits and political unpredictability, there could be significant repercussions for the dollar and U.S. markets. When it comes to risk, many people mistakenly equate it with volatility. This is largely because volatility is easy to measure. But in reality, risk is the probability of loss, a future-oriented, qualitative concept that can't be precisely measured. Even after an investment has succeeded, it's hard to determine whether it was risky or simply lucky. A safe investment and a risky one can both result in a profit, but that doesn't mean the risk was the same. A critical type of risk is being forced to sell during a downturn. This is far more damaging than buying high and holding through a decline. If you sell at the bottom, You not only lock in losses, but may also miss the eventual recovery, which is the essence of long-term investing. Fear-driven exits often lead to permanent damage to a portfolio. Risk, in essence, is a product of ignorance. It's the uncertainty surrounding what the future holds. If outcomes were known, there would be no risk. What makes risk so difficult is its deceptive and hidden nature. Often, when people believe there's no risk, that's when danger is highest. Conversely, a heightened awareness of risk tends to make people more cautious and, paradoxically, makes the situation safer. As prices fall, assets typically become less risky because the downside is already absorbed. But most people see a falling price and think the asset has become more risky. Similarly, rising prices increase risk, but they often attract more buyers who confuse past performance with safety. This backward logic, this perversity of risk, is what causes many investors to underperform. Ultimately, risk only manifests when negative events occur. As Warren Buffett says, when the tide goes out, we find out who's been swimming naked. It's in times of stress that we discover how much risk was really present in a portfolio. Good investors understand that markets don't reward comfort. They reward insight, discipline, and the ability to navigate uncertainty without succumbing to fear.